talking about $1 trillion being wiped off the value of Australian real estate out of the wealth of Australians.
But with Victor's controversial thing about paying your investments first and come to your mortgages later, isn't that where that collapse happened? Like
the logical thing over here is that this is the time to load up, knowing that within the next 18 months to 2 years, we will barrel past our high.
How you going? Phil Tarrant, welcome to Property Investing Insights with the Right Property Group. We're back in the studio. Reshmi and Victor Kumar, gang, how you going?
Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
good. How are you?
Good. Very purple today.
I know. I'm just seeing purple everywhere for
just
some
noticed
reason.
it. It's good. I like purple. Purple's a good colour.
Yeah.
Purple is wealth.
Is purple?
Oh, is it?
Yeah. That's how.
Okay.
So if you look at the Robert Kiyosaki books, when they did the initial cover design, they used royal purple. And if you look in the medieval days, anyone that was wearing purple was only from regal descent, because it was very hard to actually manufacture that color.
Purple was difficult in those sort of dye pits where they used to try and sit there and make them. Yeah.
See, I like the burgundies and the purples.
That's
and
a
plums.
really-
Yeah.
It's just a random thought that popped in my head.
Random thought. How do you know this? Because you read the books.
I read a lot. I read a lot. Phil,
He
and I
lives
watch
with
a
the
lot
queen.
lot of movies, a lot of
Do you actually
documentaries.
like really read? I'm not talking reading your social media posts. Like you read books.
I read your posts.
Yeah.
Your articles.
Yeah, great. Yeah, which are very good, by the way.
Yeah.
I haven't done one for a while.
Yeah, shameless plug.
There's been nothing yet that's annoyed me enough to actually pick up a pen again. Well, I think the last time I did it was around all the super fun lending,
course, yeah.
finishing up, and I said, I can't remember. Don't let a buyer's agent's marketing campaign be your retirement strategy, right?
Which is true.
Yeah, which is true. It's the last time I picked up a pen, but I've got. I don't know, maybe you can give me something today which is going to annoy me enough to think I've got to.
No. We are the voice of reason in today's market.
Reason and sensibility.
That's it. Yeah, so we can't give you anything that's really noteworthy from a journalist point of view. We are boring.
Boring.
Yeah.
I think one thing, I don't know, maybe you can see your view on this, but I think I was musing about it the other day. I think the next thing I might have a crack at is every property investment advisor these days is now an expert in commercial.
Oh, yeah, of course they are.
Yeah.
Yes.
Yeah. So I think that's my next bit. Everyone's sort of saying, well, super's a great place for commercial property.
Yeah.
I'm like, yeah, maybe. Maybe not. But
Be careful of people learning on your expense.
there you go. Which happens a lot in this game.
Yes.
But purple. I never knew that meant wealth.
But there you go.
That's why I have no purples.
See, that's why,
I don't have any purple in my wardrobe.
that's why I get paid the big bucks.
Double purple.
I know
as
these
well.
facts.
Double purple.
Double
There
purple.
you go.
Oh my God.
Maybe we
Okay.
should change the branding colours for this podcast. I do like purple as a colour. It's a
Yeah,
good colour.
purple. Well, Reshmi is an investor women color.
Yeah,
purple,
that's
isn't it?
purple.
Oh, yeah, there you go. How's all that going?
Burgundy. Yeah, good. Really good. Yeah. Awesome. Yeah.
Yeah, you enjoying it?
I'm enjoying it.
Yeah.
Finally doing what I've been wanting to do for a long time. I was doing it, but not to this level.
Yeah.
So it's good.
It's nice to have bandwidth to do stuff like that, which is always handy. But, it's cool. Yeah. Anyway, I'm sure I'll find something to annoy me, but watch this space if you want to read stuff. Now, what books do you read? Tell me some books.
Well,
I'll put them on the spot.
back in the day, I used to read Clive Cussler and all of those. So these were just in fiction books, right? But these days I mostly autobiographies. So at the moment I'm reading about Obama.
Okay.
Yep. And before that it was Harry.
Yep.
And
The Spare. Did you read Spare? Did you?
yes.
Oh, yeah.
And Richard Branson's books. Any book that I can get my hands on. These days it's more on the phone or on the computer because the eyesight's a little bit going and vanity doesn't allow me to wear glasses.
Oh my God.
Or
the audiobooks. So when I'm traveling, right, obviously from home to the office is about 45 minutes on a good day. And I usually have an audiobook on. A really good podcast, How I Made It from Financial Review. They give you good insight, and then you link one aspect of knowledge to another aspect to create, what's the narrative over here?
Yeah, it opens your mind. You can think differently. Yeah.
Yeah, it's good to have different perceptions and ideas, and and as a better humble buyer's agent, you're probably always out and about looking at properties as well. Plenty of time to consume information while you're out there doing it.
Yeah, not so much out and about, but when I get bored, definitely I go and view properties instead.
Bored in looking at properties instead. Oh my God.
How many properties do you reckon you guys looked at over the years?
I don't want to look at any property.
Have a shot. 10,000?
More than that, definitely.
More than 10,000.
Yeah, definitely more than that.
This is many, many years ago. We thought when we do the numbers, how many would we have looked at? And when we started counting, and that's long time ago, it was already over 1,000.
And that was when we were radiographers back then.
Back then. That's because remember, you had to see so many to select and then put your offers in, and only one of them someone might say yes or no to. So you had to do a whole heap of them.
That's a lot of properties. How long do you need, Reshmi, to actually view a property, do you reckon, to do it well? Or do it enough?
If you've been doing all the time, like if that's what you've been doing, then it's very quick. You know your structure. Like you walk through the front door, you go through the steps. Okay, this wall, this joint, moving throughout the property. You know exactly, and you could be out of there in 30 minutes. Yeah. So and under the house, and under the sink. So there's a step process to go through, scanning the walls, scanning the floors, the height. If the floors drop, then under the sink, piers up, lots. Just tick. Yeah.
You have a tick box though.
We used to back.
No, it's all mental, right? So I can pick stuff up way before pest and building inspectors do. Like on our current purchase that our interim PPOR, I literally went through that for 5 minutes, and I'd already picked up bathroom was leaking. There was a few cracks here and there, and when we were back, I was talking to the agent and said, "No, your bathroom's leaking." All this sort of. That's part of our negotiation. And the agent had shown that property for over 8 months, and no one had picked that up.
How'd you know the bathroom was leaking?
Just a simple thing of looking outside the wall to see any discoloration, and they're just
outside the building.
No, in the internal wall.
Okay,
and it was just above the skirting board, so it was hard to see. But that's that attention to detail.
Yeah. How much did you get off the purchase price as a result of it? Enough. Can't help himself. Can't help himself.
No, that was a good buy.
Yeah.
I think, we did.
And you still sort of enjoy looking at properties, like when you do it, when you find a time.
It's become now second nature, right? So it's a bit like driving, right? So initially when you're driving because you want to drive and all that. Now you drive unconsciously, right? You don't know whether if it's a manual, you've shifted gears or not. You don't know whether you've turned on the blinker or changed lanes, all of this sort of stuff. But it happens automatically, and that's what property is to us now.
There you go. Well, whether or not there's more people in the market versus how it's been in the past, who knows? And I know you guys are trying to give a sense for this, and you haven't yet seen this. The crew over at Right Property Group released the Q3 2026 investor edition of the Australian Investor Sentiment Report, so measuring investor confidence, behaviour, intentions and market sentiment among Australian investors. Good initiative.
Yeah, it was. It was all Reshmi.
It's all Reshmi? Was there any, before we sort of, and we'll pick it apart because I'm sure a lot of the areas that you've addressed inside of it are probably thought process that a lot of Australian investors going through. I know myself included, like, do you actually do anything now or do you wait? You pick up the paper and, NAB's telling you that rents are going to rise by 30%, and then you read on another page that the downward trend, we're probably not even a quarter way through it all. So, we're already down, I think, 3% nationally, and they're saying that there's going to be, at least another year or so of negative.
Negative growth.
Negative growth.
Yeah. Or slower growth.
Slower growth. So do you do anything about it? But the catalyst for the report, Reshmi, just to get some facts and figures?
Well, nothing really stands out apart from the fact that people were saying that the borrowing is what they're really worried about, which has dropped quite a lot. And that's what they're concerned about. But people are still very resilient in wanting to invest. But the borrowing is what holds back.
Yeah.
So that's the main thing that we've picked up on there.
Yeah, and Reshmi and I were having this conversation. How this really started was we were talking about business direction, business robustness, and all that, and said, well, really, let's not second guess ourselves. Let's go out to our client base, our database, and let's find out from the real people that are on the coal face, and the results speak for themselves.
Yeah. So some of those headline numbers, and so you've surveyed people inside of your ecosystem.
Correct.
So they would all be property investors, right?
Yes.
So you could say, well, it would be a bias to the findings, but if you go, well, it's not a bias because you're surveying people who actually invest in property. So it's a very concentrated survey. 54% expect prices to fall, and these are headlines. We'll go into a little bit further. 44% are confident in property in the next 12 months, and 40% intend to purchase in the next 12 months. So if you did the same survey the year prior or 2 years prior, I doubt that number would probably that different about intent to purchase in 12 months, 40%. Not all people can invest all of the time because there's always constraints around borrowing. So I'd be really interested to kick off with that particular number. Yeah, they intend to purchase in 12 months' time. Whether or not they're going to be able to is a different thing. But do you think that you reckon that number's dropped much since previous cycles?
So in terms of this sample, these were already investors, so they own property. And so that's the tilt to this. Has it changed from the previous months? Away from this report, if we look at what the lead positions are, what the conversations are out there, and match that to headline and the change in social media articles and adverts, I would say that there is a drop. Noting that this is the first of the Australian investor sentiment surveys that we've done at this level, so it's a bit hard to draw a parallel from yester quarters because we haven't got the data.
No.
Yeah, so we'll be able to compare and contrast moving forward. And you're going to be doing that through a downward cycle rather than an upward cycle.
Yes.
So that's why data like this is really good because it can help you sort of map and monitor the trends. Now, information is only as good as how you choose to act on it.
Absolutely.
So, sharing this may have a lot of people agreeing with the sentiments around it. Others may feel otherwise. So to your point, so key findings at a glance, borrowing capacity is the story of the quarter. So 52% name it as their single biggest challenge, and 43% say the capacity is reduced over the last 12 months. Can you give me a sense for your cohort of customers or clients? How many of them would be people who have traditionally operated through more sophisticated vehicles like trusts and businesses versus investing in their own names? Would it be?
It's balanced.
It's balanced.
It's balanced.
Yeah.
It's because we've never been very strong proponents of set up entities and buy through there. There is a natural progression, and hence, my earlier comment that we are the sound of reason in today's market, right? You don't just do knee-jerk reactions and get into entities and sophisticated structures that might not actually achieve what you think it will achieve. Ultimately, the holding cost still comes from a household, right? So we need to be mindful of that.
Yeah.
And we also need to be mindful of, now that the dust has settled from the headlines of negative gearing, whenever I'm in conversation with people, a whole heap of them don't actually realize that the negative gearing is actually deferred. It's not gone, it's actually deferred. So understanding that in the front end, you're not able to claw your so-called losses. And if the property turns positive or when you sell, you're able to claw that back. Is really important, right? Because then it brings new light to which structure you're going to own the property in, and also understanding the household cash flow, that whether you're owning it in a company, a trust, or personally, you still have to come up with a shortfall from somewhere.
I was just going to talk about the webinar that we did on this topic. It's still on the website. So if anyone wanted that clarity, it's definitely there to go and refer to.
Yeah, there was a lot of confusion in relation to these changes, and you see it all on social media now. The memes of government ministers trying to articulate something they have no idea about. They don't even they don't understand negative gearing. They don't understand negative equity. You even had the Prime Minister there for a bit going, we thought about maybe limiting negative gearing to 2 properties, but then people would just load up the debt on those properties, keep it negative.
Doesn't work that
way. It's not actually the way it works, right? There's got to be a purpose for the money that you drive the debt up on your thing. So a lot of people didn't really understand it, and it wasn't really articulated or communicated effectively. But
I think you should go there and be the property investing minister.
You reckon?
Yeah.
Minister of property investment. Oh, God, I'd probably get chased out of town. At least I'd probably sort of know what I'm talking about.
You take cashes in the back to be able to change legislation.
Oh yeah, mate. There's yellow envelopes here and there. Mate, you laugh about corruption in politics. Some of the stuff going on right now with all these ICAC investigations and stuff. You sit there and just go it's a murky world.
That's right. Yeah. Well, corruption's two stages, right? So one is the actual money corruption, but the other is information corruption, right? And this legislation change, it pretty much is information corruption. When we've got our own PM saying that you load up the 2 properties and increase your negative gearing, that's information corruption.
Yeah. Well, it's misinformation. I don't think it's disinformation, but it's certainly misinformation. But this is the issue with the way information is propagated now, because you do a survey like this. Yes, it's facts and figures, but anyone can use this information to manipulate a position.
Of course.
Right. Yeah. And governments are very good at this on all sides of government. I guess there's 3 sides of government right now. There's the government, then there's a couple of oppositions. But you can use this information to paint whatever picture you want. Yeah, you can say, wow, 40% of people intend to purchase in the next 12 months. What a great story.
Yeah.
Or only 40% of people intend to purchase in the next 12 months. That's really a negative story. Choose your version of how you want to paint it. That's why you got to be sort of considerate with information like this, because it tells you something. So you choose to compute it and synthesize it and act on it. Now, borrowing capacities through the quarter, 52% said it's the biggest single challenge. Well, it's probably always been a challenge for a lot of people.
Yeah, it's a little bit more so now because with a lot of the banks, the calculators actually added back the negative gearing. So now they have to, for future purchases, they need to take that out of the calculator, right? Which immediately takes away 20% of your borrowing capacity, which would mean that the 44% that are saying that they are looking to buy in the next 12 months, maybe out of that, only 50% are able to buy in the next 12 months.
Well, it'll be, have they got the money to deploy to buy another property? And if they don't, if they're refinancing it, well, it's double sort of compounded factor of, having to load up your current debt to get that money out, which you might not have a serviceability, and then the serviceability on top of it. But I'm already hearing that lenders are,
they're moving.
They're moving. They're a little bit more fluid in their assessment criteria around it, and some of them are even, layering in or factoring in, not all aspects of the negatives and negative gearing, right?
Yeah. Well, if you look at it, right. So Reshmi, you and I were discussing 44% are looking at buying in the next 12 months. If lending is going to be an issue, the bank is going to recognize the intentionality of these people, and will create the products. If you remember back during the GFC, the split loans.
Yes, we're talking about setting up funds and stuff.
No. So this is the split loans where
lots of things we discuss. I don't know which exactly.
This is where they capitalize half of the loan and you pay.
Yes. Okay.
Yeah, interesting concepts, right? So you don't pay the interest on half of it; it just keeps adding up to your loan, and then on the basis that you're backing that property prices go up. The issue we have though is, Reshmi?
Isn't that where that collapse happened? Though a lot of investors were capitalizing, and then during the GFC
took away that capitalization, and the whole thing got exposed. So I guess the thing over here is that you really need to be careful getting into funky products at the moment as well.
I try and avoid them like the plague. I never subscribe in them. If you can't do it the old-fashioned way, maybe you're better off not doing it. It just depends on your appetite towards risk, right? You've got to see that in this market. If housing, again, depends who you tune into, is going to be soft at best and falling at worst, is it actually worth getting into this current market? And the 40% there may indicate that. If you spoke to these same people 2 years ago and they've had a good a good experience in property, most of 100% of them say, yeah, I want to invest again, right?
Yeah.
But whether or not you can. But back to that negative gearing thing we're chatting about, it just means that rather than offsetting the losses in your property connected with you in your tax return of that year, it just gets held inside of the actual asset itself, much like investing in a trust, right? There's no negative gearing in a trust. You just, you don't distribute losses in a trust. It just build up losses, and essentially you're just building up losses inside of your property, and then when you sell, you absorb those losses. You get paid on what's left, right?
Yep. Now on the counter side, the movement to brand new property, that in itself already what we're seeing, and this is direct from the agents, is that they jumped about 50K in price already. Yeah. So especially the off the plan ones, house and land packages, and they are usually in traditionally oversupplied areas anyway. So if you look at it, you're paying a 50K premium, and then you're still negatively gearing because the rent doesn't cover the mortgage. You're claiming your tax credits because it's brand new or less than 12 months old. You've got your depreciation. Traditionally, most people, if they don't come forward with start investing with a solid plan, they sell within 5 years.
Yeah.
So the depreciation that you've claimed along the way, you've got to pay it back when you're selling the property. Yeah. So it's sort of like a bit like fool's gold.
Yeah.
At this stage, so you have to be very careful not to pay an inflated price on a brand new property and then selling 5 years' time and having to pay back some of your deductions as well.
Yeah, and you need to speak to your accountant about that. So this is where, so you claim an expense in your financials with the depreciation. I guess you claim it, but frame it that way.
Yep.
So it's contingent to holding on to the property, right?
Correct.
Yeah.
Yeah.
Yeah. And even you speak to some accountants and they go, well, you buy a place and brand new place, you might be able to, you get a depreciation schedule, you might be able to depreciate it at this amount, but when you maximize your depreciation and then you show how negatively geared it is purely through, the rent is so far off meeting the interest repayments that, the government starts sort of getting worried and queried because there's big red flags when you're claiming even huger deductions on this stuff, which don't really add up. A lot of accountants go, oh, don't claim all the depreciation because it's just too negative, right? These things happen.
Yeah, they do. They do. Yeah. Which, has a knock-on effect on your lending as well.
Yeah. So it does get a bit complicated. 43% say the capacity has been reduced. Yeah, that's understandable. That's if you are sort of investing through under personal names. But we've got to remember also we've had 3 interest rate rises this year.
Yeah.
And potentially another one downstream. Who knows what's happening there? So, you're not alone when it comes to constraints around borrowing, and a lot of people will say, well, yeah, that was the purpose with the government's tax changes, was to actually take investors out of the market because they can't borrow as much, and then what happens? Prices come down.
Of course. Yeah.
Are you happy with sort of the market at the moment? You can easily get sort of, again, it's, half full, half empty. You can say, what a great market. Thank you, Mr. and Mrs. Government, for orchestrating these rapid changes. Now already they're talking about $1 trillion being wiped off the value of Australian real estate out of the wealth of Australians. You go, well, that's not good.
Yeah.
But, it's sort of property favours action takers, right? So, if this is the right time. I don't know, Reshmi.
I'm excited actually. I know it gives me a position to rationalize things and pick on really good opportunities. So, and it's not going to be down and down forever. So this is a time to really look at your overall scenario and try and get into the better properties,
So this is a bit of a theme that already I'm seeing emerging, and you guys have certainly telegraphed it. It's this sort of trading the properties inside your portfolio.
Yep.
This may be the time to realise some of the accelerated growth that you've had in parts of your portfolio and turning them over and redeploying that money elsewhere. Is that a good strategy in this market, Victor?
It is. You do have to look at the moving parts. So obviously, if you've owned the properties before budget night, it comes in with negative gearing. So that's one side of it. But then how much negative cash flow are you really carrying is the other part of the equation. And then third is, okay, maybe it's done its job for that part of your journey, not the property's journey, your journey. And now you need to rationalize it to perhaps step into a better quality, more productive investment. Or it is time to actually reduce the debt and maybe upgrade your PPOR.
Yeah.
So this is a very good
time.
market. It's probably the best buying opportunities we've seen. The only problem is that there actually aren't as many listings as people anticipate that there is going to be. So because of that, there isn't as much negotiation back from the vendors, except if it's a property that's actually bleeding them in terms of repayments. That's when they're very negotiable. But most of your stock standard investment priced properties, so you're below 1.5 million as a purchase price, the reduction in price hasn't been that significant unless it's in an over exuberant area where there's only investor driven. So if it's got a good mix of own occupier and investors, it hasn't come down significantly in price.
So again, it depends where you are actually trading in and around. And if you look at the market, and all markets operate differently, you're seeing prices, and I'm generalising here, prices fall in more prestige areas as a percentage versus sort of more affordable areas. And that's because you still have investor demand, you still have first-time buyer demand, and also that's where the majority of Australians are buying real estate in those type of areas. So it's holding those prices firm. You touched on it briefly, but I'd like you to explain a bit more. It's really spotting when there is sort of vendor discounting taking place. So, there's not as many listings available. And why is probably not falling faster than potentially what it was or what considered? We're still in a housing shortage. There's not enough houses. I think we're supposed to be building 1.2 million of these in the next 5 years. We're nowhere near that. And I think HIA came out the other day, or Master Builders or someone said the real number's like 1.9, whatever. So there's not enough houses, number one. Number two, mortgage arrears are still fine. And there's a lot of people, a lot of fat inside of their offsets. So people are only putting their properties up for sale if they really, really need to do it in this particular market, or they're actually functionally trading and transacting, trying to capitalise on this market. So to buy and sell in the same market with an upgrade or a downsize. So that's the reason why there's not as many discounts out there. So how do you know when a vendor is committed to sell?
Well, you got to look at the mechanics of it, right? So we've had how many rate rises? Five rate rises
This year three.
This year's three, but so far
five,
from the 2% interest rate, we've
there's a lot. There's 13. There were 13 last year.
There was 13 rate rise, and it went down 2.
And
then went up 3.
3.
I think.
Okay,
something like that.
Yeah.
Don't know what I'm talking about.
So you've got. Let's agree. We've got a dozen rate rises.
There's a lot of rate rises. A lot of rate rises. Yeah.
So you got to look at that mechanics, right? So that would mean that anyone that has, and this is where research comes in, right? So anyone that's bought a property 2020, 21, and they've got a hefty mortgage, they've bought it at 2% interest rate, right? So there is a dozen hurts that have come along their way in terms of interest rate rises. Then you look at most of them would have fixed for 3 years or 5 years.
Yeah.
So let's say averaged out to 3 years. That means that they have come in very recently into that higher interest rate climate. So 3 times their repayment amount. And they would have been able to sustain that for a year, 18 months before reality hits to say, we can't do this anymore. So you're bigger priced for that area, right? For that suburb, your higher priced properties are probably a lot more stressed. And the way you pick up the stress, we were talking about the number of days it has been listed, and using tools like what used to be called RP data and various other tools, we can track how many reductions they've had or how many times they've put it up to auction and then withdrawn.
Yeah.
So it tells a story.
Yeah.
Yeah.
Right? And that's how you'd spot it. And then
So you're talking about the valuation that I was pointing out to.
Yes.
And the reasoning behind it.
yes.
Yeah, okay.
Yeah. So you go on.
No, all good. All good. You go. You're telling the story.
Often in the evening, Reshmi maybe do something in the home, and I'd be doing something in the other end of the house, watching a movie, reading, or just catching up on emails. And I receive a text from Reshmi saying the place that we're buying at the moment, saying, they were 60 days on the market. They've been on the market since September last year, and then they had it on the market for 5, and now they've had it for 4. And context over here.
It's just different perspective. My thoughts were that, it's great. I'm thinking, wow, this is how much it was and this is where it is now. We've done well in purchasing this property at even lower than that, right? And here he's thinking, what were you saying?
Thinking,
Oh my gosh.
I think. Are you saying we've overpaid?
Yeah, it's like, oh my God. I was like, okay, yeah.
But that was a clear indication, right? So of stress.
Yeah.
Yeah. And then asking the agent of the circumstances, and you got to be, you have to have the art to ask that question, because you're not asking that question directly. Yeah. And the agent did allude to some medical episodes that the vendor was having, and then doing simple title searches. It's all in the contract.
Yeah.
You can pick up telltales of, okay, there's a caveat here, there's a refinance here. It all tells a story.
It's a story.
Once you've got that story, then you can understand the motivation and the potential for discount. Then you need to look at their problem and see how your offer can actually solve their problem.
Yeah. Trying to work out their problem is the key thing.
Correct.
Correct. And an agent typically not give you too much info,
No.
So sometimes, do you ever give an offer which is like, here's this offer which with this bits and this offer with these bits, choose one?
We gave them 3 offers.
You gave them 3 offers?
ABC, right?
Okay.
Choose one.
And how different were they? Price point was probably different.
Yeah.
Terms are
Terms.
different.
Yeah. And our aim was always to have the terms on it.
Yeah.
So obviously the one with the longest term came in with.
And it's bit by bit.
Yeah.
First get this done,
Yep.
and then get this
It's
put
the art of
in.
the
It's like,
negotiation. You always load up.
Even though
stuff
you
and
want
give
all
away.
of this, you can't say all in one hit. So
It's all good fun. Good
Yeah.
fun bit about it. But it's about understanding where the middle ground is, and that typically will help you find out what
Yeah.
the solution is for them. Right?
Yep. Yeah. So you understand the true value of the property first, right? And so then you're putting the emotion aside. And this is any property, right? And then you're also looking at, okay, where are the real comparables for this particular property that you're looking at today?
Yeah.
And where were they 3 years ago? And project out 3 years down the future to see where the value is likely to be. And what do you need to do to bring it to that higher value in 3 years' time?
Yeah.
So that then becomes the exit strategy, right? So, and that's today in today's market, that's the way you would approach property investing, so that you're not getting caught up with, geez, it used to sell for 600 and I'm picking it up for 550. Maybe it was already worth 550 all along. It was just the exuberance in the market that took it to 600.
Yeah, and this is what a lot of people are saying. They're not talking about it being a property crash. They're talking about it being a correction.
Correction.
To where it's maybe some of these areas were exacerbated for all these different reasons and grew faster than what they do. So to play with this, then you obviously need someone to live. It's principal place residence, but is it a sell in time or is it a converted in time? Not too sure, because you would have been buying it for the utility of it today, and you would have no doubt got a good price for it versus what it was yesterday. But you got to be thinking about,
It'd be a selling time, for an investor who's really done well and known that this is my time. And an investor who understands the market, understands the cycle, and has picked a property a few years back, and knowing that, this is where we're heading into, and I could offload because it's done its job. I could get rid of it here. At this. So it's based on the investors' real scenario themselves. What it is, what they want to do, and what they've been doing with their portfolio. So it's good for them to sell and then get into better quality properties if they wanted to, or for the other people, yes, great to buy more if you can, because it's going to go up anyway. So yeah, different people, whatever their scenario is. Yeah.
So you have to identify whether you're still in the acquisition phase or in the consolidation phase, or are you still very much stuck in the planning phase?
Yeah.
You don't know how to tack in today's market. I mean, that's where we come in. We can tell you straight off whether you should or you shouldn't, and what you should be buying, not necessarily where.
Yeah.
Yeah, and that's the key. Back to the report here, the Australian Investor Sentiment Report, and obviously you spoke about borrowing capacity, and that'll be the major driver for shaping property markets and actions that, you've always said property's a game of finance. You're not buying if you can't get finance. So it starts there, but confidence is cool but not cracked. Half of investors feel less confident than they did 12 months ago. 40% still intend to buy. So it's really a mindset thing. Do you intend to capitalize on this particular market, or are you happy to wait in the sidelines and maybe miss out for a bit, but are you going to miss out forever? Who knows, right? It's the sentiment. Market sentiment is one of the major drivers for negative growth in property at the moment when you consider some of those taxation changes. Key point here, price expectations have turned bearish. So 54% expect prices to fall over 12 months. Only 14% see any increase. And again, it's going to depend where you're where you're buying.
So if you look in that report, the people who have given the answers here, the number of properties they have, so there are quite a few people with like some advanced investors and all that. So I think the last page might give you who they are, and this is from their way of looking at things. So these are not like just anyone wanting to invest. These are investors themselves with multiple properties
that have got runs on board.
Yeah. So they really understand.
They don't need to be convinced about properties. No. So I imagine then you've probably got it's a more bullish cohort here in terms of attitude or appetite towards investing, and because they're probably educated, they're bearish about prices moving forward. Have you guys even thought about how much your portfolio has gone down in value? Have you even tried to calculate or sum it? I haven't.
No.
It's not really a thing,
matter.
right? It's like, so you still think, well, prices are coming down. You think prices are coming over here, there's an opportunity. You're not thinking, oh, prices are coming down here, I'm losing wealth.
No.
Because it's geared towards cash flow, right? You just go, well, probably it's going to go back up at some point.
It will bounce back up, right? And on that, I'm going to bring my phone out because I took a photo of something that really resonated with me on the social media. Just trying to find it, and I credit where credit's due. This was actually Tom Panos. Right? He's putting out some really good content out there.
Yeah.
Most of them are quite controversial.
He's a bit controversial, man. I'm actually catching up with him on. I'm going to do a podcast with him in a couple of days. So I'm sure we won't hold back for that.
Yeah. So he did, and I'm quoting him because I've always been saying, and we've been always saying that 18 months is the maximum that downturns normally last, right? And he's put out a social media post, and the header is "Every correction ends." Yeah. And then it says the last 6 Australian property downturns have lasted 20 months or 4 months.
Yeah. Okay.
Right.
What 20 months from
start to finish.
From start to finish.
Yeah.
Okay.
So the longest one was 2010 to 2012.
Yeah.
Right? That was 20 months. Yeah.
That was the GFC.
Just after the GFC. So that was when the finance changed.
The capital.
Yeah. And then 2015 to 2016, that was a 4-month downturn.
Okay.
Yeah. I couldn't put my finger on what had caused the downturn there, but I think it could have been the
interest rate.
Interest rate. Yeah. I think it was interest rate.
Yeah. Then 2017 to 2019, that was APRA induced. So that's
slowing investment lending.
Yeah. 19 months.
Is that 19 months?
19 months. Yeah.
Okay.
So this was where overnight banks that were responsibly lending at 90% couldn't lend at 90%, and then you know the story. COVID 2020, 4 months.
Yeah.
Yeah. Because biggest hit, 4 months.
March through sort of August it was.
That's right. And then 22, 23, that was 9 months. That was the first lot of interest rate rises. Yeah. And then 24 to 25, that was 3 months. Right. So when we had the next lot of interest rate rises.
Can't remember that. Yeah.
So if you look at that,
So they were downturns. So the corrections. So the prices come off a bit.
Yeah. So the red lines were the biggest red lines, the longer ones, were the ones that were materially changing people's borrowing capacity. So APRA changes and all that. So when you look at today, we're pretty much into month 3 of these changes, give or take, which would mean that realistically, if you look at it from most pessimistic, and of course we can't say that the past performances create future expectations, but the trend is there. That likely that we've got another maybe 12 months, 15 months of softer market. After which, when you look at the following trend, which I dove in and did a bit more of fact digging, immediately after downturn, it barrels back up to its original position. And the longer the pent-up demand, so if it's been in a downturn longer, it tends to break past that price ceiling and go well beyond it, right? So the logical thing over here is that this is the time to load up, knowing that within the next 18 months to 2 years, we will barrel past our height. So obviously don't buy something that's well beyond your holding capacity. But this is perhaps the time to sell down in a slowing market and replace it with better properties. So you're changing stuff in the same market, so it's okay. Yes, you lose your negative gearing, but you'd get a better performing property, arguably, if you get the selection right. Maybe you're cashing in all of your units and getting into a house and building a granny flat.
Which you were trying to
do. But I timed it a bit wrong.
You don't need to do that anymore now.
I love playing this chess.
I don't know.
You don't need to do it.
I don't want to do this property thing.
You don't need to do it anymore. So the prediction is, though, this will be a longer cycle.
Potentially a longer cycle. So not a 4-month cycle.
No, but the speed, the length of time down will determine. You go back and look at these stats, how quickly it will rebound to where it was, and then overperformance from that. So this is catch-up period.
It is catch-up period.
You assume a straight line. It goes like this, and these grow at speed, right?
So what I call the revenge growth.
The revenge growth. The big question is that whether or not that's going to. When's the next federal election? May of 2028. As it sits right now, I can't see the government changing in 2028. So what is it?
Okay, so this is the expectation of change, which will create that momentum. Right. So there'll be a rhetoric of for sure, Liberal would come in and say we're going to change negative gearing back, or we'll dilute it. Labor most likely may say the same thing, right? To echo it. Who knows? But this is where human behavior, right? The expectation of it comes in to say, okay, there's going to be change and I want to jump on the bandwagon. So it then becomes self-fulfilling. By the time election night comes in, it is the property is already in momentum. And really important that we understand that this next 12, 18, 24 months is not all downturn. It is reduced volume, reduced confidence. It doesn't mean that month on month will be going down in value.
And that's encouraging, depending how you see things.
I've got this perfect crystal ball that we bought from Kmart. And it predicts the future.
I think I got one of them. I got one of them as well. And again, if you are able to secure borrowing or your borrowing capacity is still strong, well,
now's the time
you'd be one of the sort of considering it. One of the other key findings here is sort of touched on at the top end of the podcast. Commercial properties entered the conversation. 23% named commercial as the property type they are most interested in. Second only to houses, a striking result for residential focused audience. So,
What?
Chasing the tax deductions, right?
Chasing the tax deductions. Chasing the tax deductions. I think when you look at borrowing, what really hasn't been thrown into this yet is how lenders are in the business of making money through borrowing. They need to get loans out the door in order to satisfy their healthy profits of the banks. So I think you're going to see some innovation there. I haven't seen anyone come back out saying, we're really like trust-based business again. Maybe
That's sort of fallen off the wayside, hasn't it?
Yeah, maybe that might bounce back.
Mind
We still
you-
got these buffers are still at 3%.
Yeah.
There's a lot of things that can be tinkered with
Correct.
in order to accelerate borrowing,
Yep.
which will accelerate housing. Whether or not the government will try and intervene in that, Reshmi, I'm not too sure.
I don't know. Well, nothing much makes a difference.
Yeah.
So
Don't know what we do about it all. What do you do about it all?
Look, you play with the cards you're dealt with. It's just like playing poker. You got to hand some back. You got to you replace with better cards. And in the end, if you are a strategic, good player, you end up holding a good hand.
So it might be okay to change your hand.
Correct.
That's what you're
Yep.
saying. But it comes with expense.
Of course, it does.
Yeah.
Yeah, it does.
This is the one thing I'm sort of chatting with accountants, and I've done my tax recently and stuff, and you sit there and just go, why do I sell stuff? It just causes me problems.
Yeah,
Yeah.
tax problems.
You just sit there and just go,
Yeah.
it's you go, I sold it for this much, but once it all washes through and you do all this, I sit there and just go,
Wasn't worth it.
was it worth it?
Yeah,
Like,
unless you've replaced it with a better asset.
with replacing a better asset, right?
Yeah.
Like as long as you've got a reason for selling, just selling for selling's sake, so you got some cash, I don't think really sort of
It's too
justifies.
expensive.
It's expensive. It's more expensive to sell than what it is to grow.
Yeah. Yeah.
And this is like this sort of musing I've been sort of working on for the last period of time. It's easy to grow your portfolio. It's hard to downsize your portfolio. Like most things in life, it's easy to grow stuff. It's harder to make it smaller.
Well, it's so final then, right?
You've got all the consequence of tax, but you start selling stuff, it changes your cash position across many, many different things, right?
Correct.
It's so be careful, and sometimes growing slower or not growing at all can have benefits because you have to deal with the selling on the other side of it, right? Like,
True. Yeah.
It's
And then
how
if you are
view it.
looking at selling today, and then if you've got a young family, have a good chat with your accountant first because it can impact simple things like childcare.
Yeah.
I was
Little
thinking-
things like that, right?
I think the portfolio itself should be a passive portfolio, but when you created it and scalable, so when let's say you're passing it on, the next generation could keep it scalable, and it's a passive thing, and then they pass on to the next generation. It just grows because the reason, so you're not selling it off to end it, but the reason for that is that portfolio provides you your lifestyle for your life once you've gone.
And the platform for the next generation.
And for the next generation. And it carries on and on and on that way because remember the living expenses will continue to go. So it's just something that gets handed over. It served your life purpose. It hands over to the next and then next and the next. So it just continues that way. And that is where, that is that sort of income that the portfolio generates, and that's your basis covered. So
Yeah, and that's why structure is so important, right? And I haven't yet seen. You've got like, they put an end to this sort of widows tax or this whatever they call it, which was if someone passes away and
or
the
the
property
divorce
changes
situation,
hands, that it retains, or divorce it retains its negative gearing credentials.
I don't think they've fully closed that loop yet. I haven't seen any articles on that yet.
Yeah, but I haven't. Well, it went through Senate, got passed. But if you just got if you've got a say you're an individual person and you don't have a partner and you cark it, and then that obviously sits in your estate, that needs to get passed on to. It either gets sold, or it gets passed on. Now they're not talking about inheritance of. Does that lose its negative gearing if it goes to a son or a daughter?
See, you are looking for something to write about. There it is.
Maybe, but I've said they're going, well, it might be okay if you've still got a partner that's connected with it, but what about to the kids first? So like that's another whole can of worms, right? Because then you think about exactly what you said, Reshmi. Property being a generational asset. Well, it's not a generational asset if it sits in individual names.
Correct.
Because it needs to be. It needs to be sold for the purpose of whatever and chunking up or passing it on. So you need to be really clear as a property investor why you're doing it.
Yeah.
Pros and cons, right?
Yeah.
Holding it in more complicated structures, but the continuity of that portfolio is great.
I know.
Yeah. It's the same as what we've done with our, how you have these shares for the holiday, what are the timeshares?
Timeshares, yeah.
So what happens when we own it and we're gone? What happens to them? People
no one is able to answer the question. We keep asking that.
It'll be in the fine print,
So
right?
what we've done is we've added our children in the timeshare. It's just not us. It's and our entity or something where they're part of it so that it can carry on. What's the point of having this thing when we're not there and we've spent all the money? It's all wasted.
Well, that's what people do a lot in England, right? Because of the death duties. They add their kids into titles over time so you get the continuity of it all. So that's why you need really, really good advice. But but this is a core point. Yield is so important. So you're building a portfolio for the purpose of creating wealth. You want your portfolio to be able to stay in a lifestyle when you finish working, but also have the contingency of being able to pass it on in time.
See, one of the things we do as part of our portfolio reviews with our clients is as they go through their decades and they're getting towards retirement phase, so as they're nearing age 60, we do introduce the concept of estate planning.
Yeah.
And we get them to sit down with the appropriate accountants and solicitors to actually start putting that together. We've put a pause on it while we get clarity on it under the current legislation, because when you get into this testamentary trust and so forth, how is it treated now? But there is a need for, like you said, progression of the portfolio into the next generation.
Yeah.
Especially when you've come along holding the properties in personal names. How does it then get transferred over? So all of those things need to be thought through and addressed while you still have the capacity and while you are still earning an income, so that if there's any shifting around of ownership, if there's any shifting around of mortgages, you can actually do that, right? So it's okay to initially own the properties in personal names and then take the hit in the tail end, because in the front end, that's the only way you could buy the property. You'd rather be in the market than sitting on the sidelines waiting for the perfect structure. It's really important that, though, in the end, that you're really looking at, okay, how do I hand over the baton?
Yeah, and that sort of structural pivot is key. Some people do it early on, some people do it late on. But no matter what, if you are transacting property, you're gonna, it's expensive. You're gonna have to pay tax on one side, and you've got to replace those assets. So there's stamp duty on the other side, right?
Yeah.
Like it's, and you can try and get it perfect, but you can't plan too much for the future because you just never know either.
It is a business. You've got to treat it like that. And I think you have to look at the value of your portfolio and look at the expense that you're incurring in order to get it all right. Then when you look at those two and treat it as a business, then it's not that you shouldn't be, spending that money and doing that correctly.
Yeah. Interestingly, the question here you asked about the primary investment objective: 34% financial freedom, 22% retirement planning, 21% capital growth. Interesting. Only 11% cash flow.
Yeah.
People want growth ahead of cash flow.
Yeah. It was really interesting. And I did smile at that, thinking they are learning and that people are on the right track.
Yeah. Expected price move for the next 12 months: 51% moderately decrease, 3% slightly decrease, 32% remain stable. Interesting.
Yep. And these are people that have been around for a little while, right? So they've seen a few cycles, they've seen a few downturns. So being able to read the market and keeping that mentality sane is really important in property investing.
Interesting. And this is a good indicator when it says target state or territory, 38% are undecided, which sort of makes sense.
Yeah.
That's why you use a buyer's agent.
That's right. Yeah.
If that was otherwise, you go, 28% Victoria, 23% New South Wales, 9% Queensland, 2% Western Australia. I think Western Australia's done.
It's done, but then we said that 2 years ago as well, right? So, he is a really good testament to can't predict the future, and you just got to buy the property with all risk mitigations in place and make sure that there is an exit strategy.
Yeah. 42% want houses. Interesting. I thought it would have been more units. 7% townhouse, 5% regional, 80% undecided, 23% commercial property. There you go. One for you. Here's the age groups. 44% between 40 and 49, 24% between 50 and 59.
Yeah.
So that's 66% of the cohort, which sort of makes sense.
Yeah. It makes sense because
Yeah.
that family's done. You're pretty much towards the peak of your earning capacity. 65 doesn't look that far away anymore. So if people start thinking of retirement, people start thinking of how do I pay off my mortgages, my home mortgage, and hence people jumping in at that age group.
Yeah. How much is it for people wanting to pay off their principal place of residence mortgages? That's still like a big thing for people as part of their strategy.
Yeah.
It is, because that's their security, that's their comfort. But with Victor's controversial thing about paying your investments first and come to your mortgages later, I don't know how many people's mindset he has shifted. So that's the other thing.
Fair enough. And a question for you, Reshmi.
Yeah.
Obviously, more men than women completed this survey. It's a bit skewed there.
Yeah.
But women don't seem as confident as men in the property market.
Women have never been the leading force. They've been always behind and seen that
I always thought
themselves.
that was the most influential, though.
They are
in
influential,
decision-making.
but what happens is it's the actions are taken by men mostly. So women are not that. They can influence, they can support, they can be there for the partner. The actions are really taken. It's a different thing. And so the women investors who are here, it's only a certain type of women who actually do take action. So it's a very small number.
I've got a different theory to that, right?
What's your theory? Here we go.
The theory is that most women are smart,
Yeah.
right?
Yeah.
And the reason they're more men investing is because the women egg them on to invest. And if it goes wrong, they've got someone to blame.
Is that what your theory?
That's my theory.
I don't know if I
No,
subscribe
women
into that.
pull the strings from the kitchen or somewhere else.
Yeah, my experience through all of this is that when it comes to property investment decision making, is that females are inherently more conservative.
Yes.
But they make the better investors.
And they make better investors as a
Yeah.
result of it.
Yeah.
They're a lot more considered.
Yeah.
Yeah, they won't hope for chance. They'll
They're not
they'll be
speculative.
be thinking about everything that potentially will go wrong. How will
Yes.
they mitigate?
Yes.
So they're mitigation investors. So they'll always make sure they never compromise or jeopardize. I'm generalizing here. I'm sorry, but they wouldn't compromise or jeopardize the family unit
Yep.
through
No,
poor
exactly.
decision making.
Absolutely.
And I think there's a lot to that.
Yeah.
And then
whereas-
the fear takes over, and the ones who don't take action is the ones who get a little bit too much into it and then don't do anything.
Yeah,
So
and that
that's
could be
where
it could be an asset, or also could be a bit of a liability, because it may mean you don't do anything. So that's why you need good advice in and around it. You guys are happy to cover all. You guys do the gender chat every now and then when you're sitting with a husband and a wife. And,
Yeah.
No, absolutely, because both come from different.
Sorry, no, I'm generalizing
Yes, of
also about
course.
the versions of relationships here. I'm
Yes.
just conscious about that.
Yeah.
But
yeah.
both come from different drivers. Yeah. So traditionally, the women would come more from a nurturing, protect the nest. Yeah. The men would be okay. Let's be a little bit more adventurous. Men tend to be okay. She'll be right, whereas the women would be, I want it to be right.
Yeah.
Yeah.
It's okay. I'd be listening to that voice. It's a good one. So how do you get your hands on this? I know it's been in the media and you guys have been doing some stories around it, but can you find this anywhere? Is this just my secret copy, the Australian Investor Sentiment Report?
No, this will be available on the website for people to download.
Yep, cool.
Yeah, that's there.
If what I'd be doing is I'd be downloading this and I'd be getting a glass of wine with my partner, and I'd probably use it as a way to start some conversations.
Yeah.
Confidence score. Why aren't we confident? What is the worst case scenario? And you should be able to frame your decision making around just looking at where those areas of risk lie, but then also compensating against areas of opportunity. And you should be able to. I think was it the Barefoot Investor that talks about that sort of date night type stuff, and
Yeah.
I think there's a scaffold to it all. I'd certainly be using a confidence measure property confident, very confident. Yeah,
We
I'd
can
use it.
just allow this goal setting guide part of this,
Yeah,
and they
yeah.
can
It's got to run in
download that.
parallel with it.
Yeah.
Yep.
Yeah.
Sounds like a great thing to do on a Saturday afternoon.
Absolutely.
That's what I'd be doing.
Yep.
That's what I'd be doing. You guys talk about property a lot at home, don't you?
Yeah, we do, but I think I don't want to do anymore. I was just thinking about this like in the weekend. It's like, oh no, just move into something else, man. And let you do the
You
property.
guys are about to start Reno and stuff, so you're gonna have
Yeah.
Yeah.
plenty of
property
builders to
talks.
complain about.
Yeah, that's it.
Yeah.
When's will that start? Soon.
Soon.
Yeah.
Early next
That's
year.
going to be
Well, I'm very excited. Finally, I'm going to get my studio.
Yeah, that's what
Yeah,
you need.
I
That's always
just-
fun, right?
Yeah.
Talking about what you're going to do and
Yeah.
how you're going to change it on the way through, which I'm sure will.
Yeah.
Yeah.
It does move. Yeah,
you know.
because you just like any journey, when you're on the journey, you see the small nuances that you need to address as well.
And get on it early, get on it tight.
Yeah.
Don't annoy your builder too much, though, Victor, because
I'm easy to deal with.
What's yours? So you should be out there cooking for them most Saturday lunchtimes. What?
Giving them kava.
Yeah, get some nice straight walls and
Yeah, that's it.
some exotic finishes, no doubt. But
I can be a hard taskmaster, and I know what I want and I know how it's done. It's just that I can't do it myself.
I do it yourself. It's the problem. My experience with builders is you're very much similar. I know what can be done. I know how much stuff costs.
Yeah.
Typically, I know how long stuff takes to do. And I probably know enough to be a bit annoying.
Yeah.
And I'm very conscious about that, where I'll sit there and go, what about that there? And you can see that. Just go, you go, what? Maybe you sort of missed that. You got to make sure you pick it right.
Yep.
Pick it at the right time.
That's true.
Pick it at the right time.
Yeah.
But love your builder. They're important people. Well, this is good. So, how do people find time to have a chat with the crew, Reshmi? What's the play?
The play is reach out on the website, and we try our best to reach back out to you within the 24 hours and have a chat with us.
Yeah.
Yep.
Okay, so I heard you on the podcast. It's really sparked some attention. Yeah. How prepared do you want your potential clients or current clients who might be doing something more to be across their lending? You want them to know before they come and have a chat with you.
Yeah.
Because then it's not hypothetical.
Yeah.
Right?
Yeah.
We can actually find solutions, and we can really say with good surety whether they should or shouldn't be investing.
Yeah.
So you like them to have already had a really good conversation with
Correct.
the broker,
Broker.
potentially understand their borrowing clout, and even have pre-approvals in place, right?
A strong conversation with the broker
Yep.
to understand where the borrowing capacity actually sits.
Yep.
And then if they can get a pre-approval, so much the better. But that's not absolutely essential, because then we can, once we have the conversation with them based on their proposed borrowing capacity, we can then send them back to the broker to get the correct loan structure done, and then get started from there.
Yeah. But even if people go, I'm thinking about investing, I've never invested in anything, I've got a principal place of residence worth $2 million with no debt on it,
Yep.
there's probably a good chance they should be able to borrow.
Yes, before you start any journey, you got to put fuel in the tank. So that's where it needs to happen first.
Okay, good. All right, that's Right Property Group, RIJHT Property Group. Go and check them out. Also on the Facebook. Any questions at all, send it through to
questions@rightpropertygroup.com.au.
Right Property Group. That goes straight to Victor's inbox, and he loves them. He loves questions. When's the next Right on Track? Have you worked that out yet?
It would be in the tail end of September.
Okay, cool. In Sydney.
In Sydney.
Yeah.
Yes,
All right.
but we'll also be online as well.
Online as well,
Yeah.
so you can do both.
Correct.
Yes.
Yeah. All right, good. I look forward to it. Well, thanks.
Awesome.
Good to see you.
Thank you.
And thanks everyone for tuning in. Property Investing Insights with the Right Property Group. We'll see you again next time with me, but these guys always do little wedge sessions as well. So make sure you subscribe wherever you're tuning into this, so you can make sure you're getting heaps of different stories from the crew over at Right Property Group. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate